Hi, everyone. This is Rob Roy, and welcome to this week's Elliott Wave Options U.S. Market Update. Early on Saturday morning during this recording after some business travels last evening. So let's get caught up with what's going on. As you can see on your screen, these are the stocks that will be featured in this recording. And as a quick reminder, if there's a particular stock you're interested in, you can go directly to it using the chapters feature in this recording. All right, so we had a lot of economic news to talk about this week. A holiday shortened week. We thought all eyes were going to be on the Friday big government non-farm payrolls report, but we just kept getting hit by negative reports throughout the week, starting off with the ADP report, which came in showing private sector payrolls were weaker than expected. And then that was backed up by the fact that the jobless claims were the worst month in 15 years. So that was another whammy that came in on Thursday. The JOLTS report, they came out on Wednesday showing fewer job openings than expected. And then it all wrapped up with the government's non-farm payrolls report on Friday, which also showed that we grew by less than expected numbers. And sometimes that number gets inflated by the government adding jobs, et cetera. In a weird twist, the unemployment rate did tick down to 4.2%, but it was just gut punch after gut punch with the economic data, and it goes back to the concerns that the Federal Reserve is going to be late to the party with the rate cuts. Talk more about that in a few minutes. Let's take a look at a chart of the S&P, and as you can see, it was a pretty ugly down day on Friday after moving down earlier in the week. So we had the move down the beginning of the week, and then we kind of stabilized, waiting on Friday to see if that could change things. And no, it just followed through with the fact that the jobs market may be weakening quicker than expected, at least quicker than the Federal Reserve expected. And so the high of the day touched the 10-day moving average, and we did close below all the three major moving averages, 10, 30, and 50-day moving averages, which is significant. But if you've listened to me in the past, you know that one day doesn't really mean a whole lot. Now we have to look and see if we have follow through. What's going to happen at the beginning of next week? Do we continue down? We had talked about the fact that a couple things could happen. Maybe we broke out of this wave 5 moving towards the election, and then we stop the move, or with the fact that we were having trouble at this resistance level of that wave 5 from July, maybe we roll over. It did have a little bit of a rolling top type of a formation to it, rounded top, if you will, and it appears that could be what's going on. If the wave 5 is indeed done, that means that the next target comes down all the way down here to this previous wave 4, and that's quite a ways down and a long ways to go to get there. But at this point in time, if we can't recover this support level here above the 545 level, get back above the major moving averages and try to make some sort of a run into the election, and say that the likelihood is that this is done. First stop will be at this low from the beginning of August, and then on to the previous wave 4. So ugliness across the board in the markets. Let's take a look at interest rates, where all the action has been. You can see that on the TNX, the rates are moving lower. We showed the triangles last week in both the TNX and the TLT. I'll show you that chart in just a moment. And there's the breakout of rates. We had a little bit of a false breakout to the upside, and then the big move lower. And if you remember, I was making the comment that we didn't really want to see rates go down that far, because if they did break to the downside, that was an indication that the economy was weakening faster than expected. A break to the upside would have been that inflation was rearing its head. So there really was no good scenario breaking out of this triangle on the TNX. And so the one that's occurred is the downward breakout as the weaker economic data has come in. The concern with the Fed just wanting to cut 25 basis points, or a lot of speculation that only be 25 basis points in September, that they're behind the curve and they're going to need to cut more aggressively. I know y'all like the TLT, so we'll show that. We've been showing that at a lot of the different webinars that I've been doing since I know that everybody likes to see it. This is a little bit longer on the curve. There was an uninversion slightly, and then reinversion of the yield curve. And just been talking about this every opportunity that I've had, including on our Tradefinders week in and week out, on how the bond market for a very long time has been screaming recession. And all the talking heads in the financial networks keep talking about soft landing, soft landing. And one of the things that I learned over my 25 plus years of doing this is never to ignore the bond market. The bond market is almost always right. Nothing's 100% in the world of trading, regardless of the security, but the bond market has an amazing record. And I think maybe we're starting to see that. Now, the economic data, to be fair, has not shown a recession yet, but it's certainly showing things are weakening rather rapidly, and we could end up with a full blown recession. And that's going to put a bid in the uh, bond market. And so the 20-year is breaking to the upside. Remember, the 20-year is prices, the 10-year is rates. So they move inversely, or they show inversely on the charts. So downside breakout out of TNX, upside breakout out of TLT. And if you'd like to join us for Tradefinder for these kind of discussions, we do it every week on Tuesdays at 1 p.m. Eastern Time. It's free. We talk the markets, we look for trade ideas, and we have a live Q&A, and we've got a really good community of people. They ask for great stock symbols, share things back and forth. I'd love to have you be a part of it if you haven't signed up already. So just sign up with the link you see on your screen, and hopefully we'll see you on Tuesday during market hours. All right, now let's go take a look at the VIX because when we talked about how following the Yen Monday, as I've been calling it, we went back into that trading range for quite some time between 12.5 and 17.5. We kept touching the upper end of the range. Could we break out of that? We did, and we broke to the upside. And so we've had added volatility throughout the rest of the week, and exacerbated there on Friday with the non-farm payrolls report. You can see that we closed the closing bar there actually above where we opened on the VIX, which is interesting. You could normally you get when you have a news event that comes out at 8:30 in the morning like that, and you have a weak opening. Usually the VIX will trickle down and close a little bit lower, but not on Friday. Almost a doji-like look there to the VIX. So now 17.5, at least for now, as support, and we can expect increased volatility moving forward. I'd mentioned a lot of times where we're going to have a buy the rumor, sell the news on the rate cut. The rate cut is coming this month in September, and it seems like the sell the news has started just a little bit early. And again, that has some speculation that the Fed is going to be too slow and won't go 50 basis points in September. I think if they do that, the Fed sends a signal that they had policy wrong for too long, that they kept rates high for too long, and I just don't think they want to do that. So I still think there's a high likelihood it's only 25 basis points in September, and I don't think the market's going to like that. I think the market now is saying we need 50. We'll see how it all plays out. Looking at some of the other markets, the DIA, we did have the upside breakout of the triangle, but everything has just been so weak at the end of the week that even the Dow that had a little stronger chart, a wave 3 here from the triangle breakout, we broke out. We're back now testing the point of the breakout. Can the Dow hold in there with this wave 3 and turn and move back to the upside? Perhaps the selling won't be quite as severe moving forward, even if we are in a more of a corrective stance on the S&P moving into the election. It showed some charts that talked about how in an election cycle in year 4, September, October are normally kind of sideways to down months. And then historically, September has been a bad month. It always went back and forth, whether May or September was the worst month of the year historically. The last 10 years has been September. So awful lot of things piling in for why the market is moving down at this point in time. Taking a look at the Qs, and we had talked about this zigzag pattern, and if we had continued, then we have to really pay attention to, even though we barely qualified on this B wave, the C wave extension, and look how we're just following along that 45-degree angle line. That's not an indication of that's where it's expected to go. That's just how the indicator is drawn with a 45-degree angle. That's what the market does a lot, as you can see, but just kind of moving right along that line down the C wave extension. And I think there's a high likelihood we're going to see 400 on the Qs. May not be so quick, but it looks like that's where we're going. And then the IWM, and that one kind of gave up the ghost as well on Friday, giving up the 210 level right here, which is where it needed to hold. But once again, it's just one day. So we need a second day or a follow through day. If we can have a bounce back day on Monday and get all these moving averages back above their 50-day moving average, back above the support resistance lines, then perhaps we can work something a little more constructive in the markets as we move into the election. But that has to happen. Follow through would mean that more of the same is coming. And at this point in time, if there's follow through on the IWM, that means we're likely coming back down to the 190 range. All right, let's move a little bit into crypto real quick. We'll show Bitcoin. And as you would imagine, risk assets not doing so well in this market, affecting Bitcoin as well, breaking out of this triangle to the downside. And we'll see how far the Bitcoin move breaks. Remember, this triangle is big. I've been talking about how it's about a 20,000 point wide triangle. So with a midpoint around 60,000, we could have more downside to go on Bitcoin if it does follow the breakout rules from this triangle, nice symmetrical triangle. So maybe more pain to come there. I did want to show you the wave 4 here, 69%. Remember, triangles trump the Elliott Wave pattern. But when it's breaking that direction, then you can kind of pay attention to it. And same thing occurring here in Ethereum with a pretty well-formed 5-wave pattern to the downside with the wave 4 right at the 38.2% fib level. So I just want to slide that in real quick. We'll look at the metals, gold. I'm taking a look there. And it had kind of started to come back down. Looked like maybe we're going to get a downside breakout. We had this odd pattern that I highlighted last week where we had a symmetrical triangle breakout, symmetrical triangle breakout, ascending triangle. Even though GLD is known for forming consolidation patterns and breaking out, that's kind of odd, 3 in a row. Looked like maybe we're going to break to the downside here. Well, now we're coming back up because if things get really ugly in the economy, we will start to move towards more of a bid in the metals. I think it's a safe haven type play. Let's take a look at SLV real quick as well. And same type scenario here, except a little bit more weakness. So we'd had this move up in the wave 4. This is where it gets odd. We started to move down. We've got a pretty well qualified, especially with that wave 4 at the 61.8% level, wave 5 to the downside pattern in SLV, which is showing a target breaking the wave 5 below the wave 3, which is what would normally happen. And we had a bounce up with the weak economic data at the end of the week, but then back down again on the jobs report on Friday, which was interesting. And it just doesn't make any sense that the wave 5 pattern to the downside could play out on SLV and then GLD break to the upside. Seems like they'll be in lockstep, but they were a little different on Friday. So we'll keep an eye on that, on these divergences. But normally the two are, even though not exact patterns, tend to move in similar fashions. I wanted to show you oil, which clearly had the downside breakout of that triangle. We talked about this last week. We had broken down. Everything was news driven with what was going on over in the Middle East. Broke back up right to the point of the breakout on the triangle. Just perfect Elliott Wave triangle rules. And then down we go with the expected breakout move, even breaking down a little bit lower than where I thought it would go on oil. And that's just going to be on assumed consumer demand weakness. So we'll see if USO can hold support now in the 67.5 range. It would be pretty interesting if it didn't. You can see it did on Friday. But I just don't think that OPEC is going to allow it to go too much lower before they start announcing cuts in production, et cetera. UNG, natural gas, we didn't show that one last week, but bringing it back this week, we had this pretty well nailed. We had that wave 3 that was in a mono wave. Hard to know where that wave 3 is going to end. But we said once it did, it'd likely bounce back up to 15 because that's where support and resistance was and for so long. It did do that. We started down and stopped just short of, and I noted, and that's what the great thing about this algorithm, this software at hubb.com. If you haven't gone there, go get a copy of this. It's amazing Elliott Wave software, the best software I've seen, and there's all kinds of other cool features there. So hubb.com. But you can see right here, it never turned this wave 4 purple. It left it green, which means the algorithm is not sure that that wave 4 is done. Even when we were moving down and it looked like we were about to take out the wave 3, had we taken out that wave 3 low, it would have turned purple. but it didn't do that. And even though it appeared it did, the algorithm was saying, no, we're not sure. And now it looks like we've got a little bit of a bid back into natural gas, and we're going to come up and test 15 again. Can we break above that 15 level? If so, that wave 4 will move over, and then we'll have perhaps an opportunity for an actual tradable bid here in UNG. But I think you still want to see it break that 15 level first. So it's interesting at this point, but I don't know that you actually want to put a trade on just yet. All right, so now let's move into stocks of interest. We'll start off with Meta. This is one of the ones that you guys ask about. I like to show that. I read all of your comments. And by the way, just as a quick reminder, every month of this year, if you hadn't heard this before, we're giving away one of our level 3 subscriptions. That's our 3 primary subscriptions at ewotrader.com. We have the time strategy, which is a sideways income-based strategies based on AI signals telling us the likelihood of a stock staying in a 1 standard deviation trading range. So you can put calendars, butterflies, any kind of income type strategy there you like. Volatility strategies, which are triangles. We had one on USO. Those kind of breakouts, that's what we look for there. And then the AI-based impulse strategy, which is heavily focused on zigzag patterns within the wave 3, so the strongest of all waves. And the AI gives us a target percentage of the likelihood of the target getting hit. So you're getting all that. It's worth thousands of dollars, and we're giving away one free every single month this year. And the only thing you have to do to register for the drawing is leave a comment underneath this video. I read them all. I answer as many as I can, time and travel permitted. And when I see that you guys are asking about specific things, I like to include them in these recordings. So let's go to Meta. And you can see here that it kind of moved right to, pardon me, very strong support level there at 500. Can it hold that? Setting up a wave 4, so still in a qualified 5-wave pattern to the upside, bucking the trend a bit of the rest of the market, if you will. So can it be the Lone Ranger and ride out on its own, or at least part way? We'll see if it can hold this area here. If not, then it's going to be a pretty quick move all the way back down here into this 450 range. So that would be the area that you would look for as support if we can't hold 500. And you can look, we closed right on it at the close on Friday, just dead on 500, below the 50-day moving average, but not necessarily below support. So Monday will be very important for Meta, but the possibility there of a potential move, even if the calming or the selling calms a bit, we can still have a downtrending market, but without the kind of volatility that we had at the end of the week in the selling. You all ask about Lilly. We take a look at the chart of Lilly, and you can see that we tested the previous high there, just broke it enough to create the wave 5. I was talking about this in our insiders meeting on Thursday night. That's for our subscribers only at ewotrader.com, alert subscribers, on the importance of holding 950. If it could hold 950, you can see how we went sideways for a while, then we could break and continue higher. But it didn't do that. So we traded through it, and now we've broken down. You can see we hit the wave 5 low on the low of the day. We hit the 50-day moving average, is what I meant to say. And can we hold that and continue lower? Or turn and move back to the upside. So if we break that, to be clear here, if we break the 50-day moving average, then we're heading lower, probably back to the previous wave 4. But if we can hold the 50-day moving average and bounce back up, you still got to break above 950. Pardon me. And if we can break above 950, then we're probably running to 1,000, and we'll see how that plays out. But for now, a failure here to break above 950. And again, Monday, just like Meta, is going to be very important for Lilly to see if that 50-day moving average holds. Looking at WBA, Walgreens Boots Alliance, and it's just been about as ugly a chart as you can expect to see. Just moving to the downside here, working its way down in this wave 3. Numerous different zigzag patterns here to the downside. We're under 10, which I wonder how long we'll stay here, because there is some pretty good institutional ownership of Walgreens, and they're not going to want to allow that to be below 10 for too long. If you're not familiar, 10 and 5 are the important price levels with institutional ownership. If the investment objective of the institution is growth, they can own double-digit stocks, 10 or above. If the investment objective is aggressive growth, they can own $5 and above stocks. Now, if it breaks below those levels, in other words, for the institutions that are growth minded and have this in their portfolios, if it stays here too long, then they're forced to sell because it's below double digits. And then that means they have to realize the loss. And as you can see with this movement here from what's happened here, they're not going to want to try to take that loss, realize that loss if they can avoid it. So I would think that at some point in the near future, we may get a bid back up in WBA and get back above that $10 level. That's just speculation, but it seems like that's likelihood, unless the institutions are done with it and they're like, all right, we're just going to sell it and move on. Looking at CELH, another one that y'all ask about here, you can see that on this movement to the downside here. Now, this is the difference between this and what I was talking about with the wave 3 and UNG, where we didn't have a zigzag pattern. Here in the wave 3 lower on CELH, we do have a zigzag pattern. And so we move down here up to the 38.2% level. That yields a 61.8% expectation on the C wave. And you can see how we went sideways here. So we found support at that level. And then you wonder if you're going to get an extended C wave, which would be to the next fib level, which is exactly what happened here. And we went right to the 100% level once again, finding support there for a while. And now we've broken below that. So it's looking like Celsius may want to go to the second fib extension. That doesn't happen that often, but it does happen. But at this point in time, a tiny bit oversold, but perhaps moving down to that 161.8% extension is where we wind up there, especially if the market continues to be weak and losing faith that the Fed has got this under control. I thought I'd show you Tesla real quick, just as a bonus one here, because we still have this triangle pattern here, and it looked like an upside breakout, and then we gave it all back on Friday. So false breakout to the upside here on Tesla, and then a movement right back down to the point of the triangle, very reminiscent of what happened with USO. So you still have to keep an eye on Tesla and see which way things break. But all in all, not bad performance considering how weak the market was towards the end of this past week. So you'd have to be encouraged if you're long Tesla, and I know a lot of you are based on your comments. So that gets you caught up. Thanks for being with us and watching. Please leave a comment underneath the video. Register for the drawing. Have a great rest of your weekend. Look forward to talking again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new Tradefinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.